Welcome to our December webinar series. I'm so excited to be here and I'm so excited to be welcoming all of you. We have so much content that Jim has to cover today that I'm going to be very brief in my introduction, but I'd like to start with a quick tech check. This morning we have Eric Emerson and Sandy Proto from our marketing team helping out, and we just want to make sure that everyone is able to see and hear us. And I can see, wow, a lot of people have already joined. So if you could go ahead and navigate to the bottom of your screen where you see in the icon bar there, the chat, if you click on that, the webinar chat should load on the right-hand side of your screen. And Ricky, thank you for telling me you can hear me loud and clear. If you can hear me, please type a Y. Thank you, Adam. Thanks, Jamie. Okay, great. It looks like the audio and video is working really well. So I'm going to move right into the schedule of events for the rest of today. And if anyone also would like to share where they're joining us from today, I know we have people from all across the country. We always like to see that. I may have time to shout out a few people. I see Wendy in Pittsburgh. We're in Pittsburgh here too. So this morning session one, goes from 10 a.m. to noon Eastern time, and it is strategic post-election Roth IRA conversion and advanced tax minimization planning. Then we'll have a brief intermission, and we'll start again. Session 2 begins at 12:30 Eastern and goes to 2:30 Eastern, and that session will be post-election optimal estate planning for married IRA owners. And then we're going to end the day with a really special session on two accounts. One, because Jim is actually going to be presenting at least a portion of a completely new, never been done as a webinar session. He did do the 7 costly retirement mistakes and how to avoid them in our in-person events here in September in Pittsburgh. But this is the first time he'll be doing a version of it online. But it will be a bit abbreviated because we have another last minute and excellent surprise edition. Larry Swedrow, who, if you have been following Jim and Lange Financial for a while, you may have seen him on our other events before. He is an investment and market guru, and he is incredibly great at answering audience questions. We've had a lot of pre-submitted ones, and he's coming today specifically to answer all of your post-election investment questions. So the first hour of that third session will be Jim, and the second will be Q&A with Larry. If you have not registered for either the second or the third, I encourage you to use the links that Eric has shared there in the webinar chat, because for these Zoom webinars, you do need to register individually. And thanks to Jim in Miami, Florida, but the weather is better down there than it is here. William in Long Island and Randall in Idaho. Good morning to everyone. I am going to roll straight in. Before I roll into the introduction of Jim, I don't want to forget this. Jim does love questions, and even though he has a ton of content, he will be taking questions throughout the presentation as much as he can. And any questions that we still have at the end of session 1 and session 2, I will try to pull them over into the following session so that we can get as many of them answered as possible. The way to ask a question is if you go to the bar at the bottom of the screen, you'll see a Q&A feature, and I can see that there are already 2 questions in the chat. And I can answer one of them from Chin. She says, will there be a replay of this meeting available? Yes, Chin, since you are registered, we will be sending a replay of this out when it is completed and produced. But if you do have a question, just click that Q&A and type your question there, and we will address as many of them as we can during the session. So I would really like to get started. I know Jim has a ton of material for this morning. So now I will just do a brief introduction and hand things over to him. Jim Lange, our presenter today, is a CPA and an estate attorney. He's also the author of 10 best-selling books that help protect the financial security of IRA retirement plan owners and their families. He's been quoted 36 times in the Wall Street Journal. Jim's books have been endorsed by the country's top experts, including Charles Schwab, the late Larry King, Jane Bryant Quinn, Roger Ibbotson, Ed Slott, Bob Keebler, Larry Kotlikoff, Jonathan Clements, Paul Merriman, Larry Swedroe, and Burton Malkiel. His latest best-selling and highly acclaimed books include Retire Secure for Professors and TIAA Participants. Hardcover and digital editions of this book are available as bonuses for attending today's webinar. And Retire Secure for Parents of a Child with a Disability. A digital edition of this book is also included in the bonuses for today's webinar. And I'll be sharing all of the details on how to request and receive these and all of our excellent digital bonus content later in this morning's session. Jim is a nationally recognized IRA, Roth IRA, and 401k expert who authored the first peer-reviewed article on Roth IRAs in 1998, published in the AICPA's journal, The Tax Advisor. His insights have been featured in Newsweek, the New York Times, Forbes, Reader's Digest, Bottom Line, Kiplinger's, and many other magazines. He is a paid contributor for Forbes.com, and his peer-reviewed articles have appeared in Trust and Estates Magazine, Financial Planning, and the Journal of Retirement Planning. As a member of the team here at Lange, I've really had the opportunity to get a unique behind-the-scenes view of just how much Jim cares about presenting great and topically relevant information in these workshops. And I can tell you that he was working on the presentation for this morning as late as midnight last night, just putting the finishing touches on it. So I know that today's events are going to be an excellent resource for anyone and everyone who's in search of great cutting edge information on retirement and estate planning strategies. This morning's session, as I mentioned, is particularly content heavy, and it's packed full of timely analysis and tax savvy retirement planning strategies that you're going to be able to apply and benefit from, whether you decide to work with us or not. So without further ado, please welcome Jim Lange.
It was 2 a.m. on February 16th, 1998, right at the beginning of tax season. I got the call. Your business is literally on fire. Many of you were actually clients even back then, and we're talking 26 years ago. And I stumble out of bed, go to the business to watch my business literally on fire. We were above a pizza shop, and there was an electrical fire. And my immediate goal was, okay, I have to get back in business and do this tax season. And it was quite an ordeal, but we were able to get through it. And it was a very expensive ordeal. Luckily, I was well insured, but I didn't get all the insurance reimbursement until the following year. So this is a little bit of a picture of my finances during those years. So before the fire, I was doing well. My income level was up here. The year of the fire, 1998, my income dropped dramatically because I had all those expenses and didn't have reimbursement. And then the year after the fire, my income went back up again. So I had this window of a very low income. And at the time, my wife and I were in our 40s, and we had about $250,000 in our IRAs and retirement plans. And I just finished the first peer review article on Roth IRA conversions in the country. So I was certainly up on the issue of Roth IRA conversions. And I told my wife, I think we ought to convert the entire $250,000, pay income taxes on that money now, and have that money grow income tax free for the rest of our lives, the rest of and to a large extent, our daughter's life, who was, I think, 5 years old at the time, and even potentially grandchildren down the road. And she does not like paying income taxes, but she's very smart. She's quantitative. She has a master's degree in electrical engineering from Carnegie Mellon. And they didn't have any of the fancy software that they have today. We were just using Excel. And I just showed her how we would be hundreds of thousands of dollars, and our daughter would be more than $1 million better off if we made that conversion. Well, she does believe in math. She saw the numbers, and she said, okay, let's go ahead and do it. And we did it. So we made that conversion, and sure enough, we are already hundreds of thousands of dollars better off, and our daughter will be more than $1 million better off. Part of this story was featured in Forbes magazine, not just Forbes.com. And it was it was a personal example of what a huge difference Roth IRA conversions can make. Now, I understand a lot of you are well past where I was 25 years ago in terms of age and different financial position. But the point is, it makes a huge, huge difference. And by the way, one other little lesson that I learned that I would pass on to you, and that is never, ever put your business over a pizza shop. What was I thinking? A really bad idea. So anyway, we're going to be talking about planning after the election today, and specifically planning for Roth IRA conversions. And when you're thinking of Roth IRA conversions and a long-term future plan, even though we don't have a crystal ball, you have to think about issues like inflation, the deficit, income tax rates, both now and projected in the future. And since we have obviously not perfect, but we have a lot more information than we had before the election. So I want to bring that information to you. Some of it might sound biased, and I try to be objective. And if I offend anybody, I'll apologize in advance. But it is kind of my vision on certain things that we should be thinking about in terms of inflation, deficit, tax rates, etc. So now, after the election, I think that we are in one of the most volatile and unpredictable times in modern history. So we have this convergence that leads to this uncertainty, starting with the president himself, President Trump, love him or hate him. I think that we would all agree that he is not a very predictable type guy, and all kinds of things could happen, even without all the other factors that I'm going to bring in that I believe increases volatility and unpredictability. We have some recent Supreme Court decisions, I'm going to go over them briefly, that have dramatically increased presidential power, as well as the transfer from some of the government agencies to the courts. We also have some pretty non-traditional nominees for major cabinet posts, and I am going to spend a couple minutes on some of these nominated positions and what the potential impact is for us, as specifically me as a long-term planner, and also for you. So one of the big cases was Trump versus the United States, and that basically increased presidential power and reduced accountability. Love it or hate it, that is the law, and I think that that is important in the big scheme of things. Another case that talked about substituting the judgment of the federal agencies in interpreting statutes or laws that were passed by Congress, where traditionally the agencies have the final word on interpreting. And now this case is saying, no, 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 we're going to have the courts interpret these, presumably without the expertise of the agencies within their respective areas. There were three other cases that more or less confirmed the same thing, which is a shift of power away from the agencies to the courts. And I think that some of the non-traditional cabinet nominees increase what I would say volatility and uncertainty. And I'll just start with one, and I guess I am going to give you an opinion here, because this, I think, is a terrible appointment that I believe will be confirmed, and that's Robert Kennedy Jr. And the reason to me, and I'm a little bit alternative, so I'm a little bit sensitive to and agree with some of the things that he says, but the one thing that he's, well, there's other problems, but the one thing that he says that really scares the bejeevers out of me is his anti-vaccination and his vaccination hesitation. And this really scares me. I do believe in science. I do believe in the vaccines. And to have a guy who is a vaccine skeptic at best, who doesn't have a medical degree, doesn't have a public health figure, be in charge of the FDA, the CDC, and what to me is kind of the gold standard of medical research, which is the National Institute of Health. He's going to be in charge of all these. And I have some serious concerns about his ability to influence parents to not get some of the standard vaccines for their children. I fear in a future pandemic that, again, he might slow down or halt future vaccines. And this is also a personal issue with me. In the let's say the height of the pandemic, I was doing a webinar, and I had an assistant who was actually my assistant, not just for the webinar, but also my personal assistant who helped me out with some personal things around the house. And frankly, I saw him a lot, and we became good friends. And I tried to be a good doobie during the pandemic. And when he was around, I did wear a mask, and I requested that he wear a mask. And I was certainly vaccinated. And one day he came in, oh, my arm, I'm so sore from the vaccine booster. So I believe that he was vaccinated. I was vaccinated. So we're doing a webinar, and he's my assistant. Obviously, for the webinar, I took my mask off, and I didn't insist that he keep his mask on. For whatever reason, I didn't. And he soon, I think like the day after the webinar, started getting symptoms of being sick. And a few days later, I started getting symptoms too. And his symptoms got worse. And he actually was hospitalized after I got uh, the test and found out that I was COVID positive. And then I did the appropriate things, but I wasn't all that worried because I was vaccinated and I had the booster. And I thought that he would be okay too, because I believed that he was vaccinated and he had the booster. Well, he didn't get better, and he had to go to the hospital. And then he died. Now, this was a guy who was a healthy guy, 20 years younger than I was, wife, young child. And it turned out he lied. He never got the vaccine. He never got the booster. And yes, I know that that's anecdotal, but it kind of really hit home for me because I believe that we had the same strain. And frankly, he should have recovered faster and better than I because he was younger and a healthy guy. But he died and I was fine. And when you have a guy like RFK who's coming in, and then I'm not going to cite all the statistics, but I think Lancet said that 150 million lives were saved from the vaccines since the last 50 years. RFK does scare me. And what the impact on that is for us, maybe Larry Swedroe can give us a little bit of light on that. But I guess my point is that we have some additional uncertainty in the economy. The Commissioner of Social Security, the appointed one, has no government experience. Social Security is pretty important for a lot of people. To me, that is scary. Spencer Miller is, his big thing is the deportation of immigrants. To me, you're talking about not only the human costs of separating families, but also losing a large number of working people that frankly often do pay taxes. I know some are paid in cash, but do pay taxes, pay into the Social Security system. I think 1 in 5 construction workers are immigrants, and we're going to lose a lot of agricultural workers. And this is scary to me, and is a possible thing that will likely increase the chances of inflation. The Secretary of Education, no teaching experience, very limited public education system. The co-founder of the World Wrestling Federation, which arguably doesn't help kids, which presumably the Department of Education does, but it actually potentially hurts children. Billy Long, the appointed for IRS commissioner, he was selling these tax credits, made a lot of money selling them, and I guess I can live with that. I took advantage of the tax credit myself, but then he was being very aggressive in his sales pitches, and he was saying, "Oh, don't listen to your CPAs, don't listen to your CPAs, listen to me." And now, just there's massive fraud in this area. And to me, that's not the kind of guy that you want as commissioner of the IRS. To me, you want a guy who has a history of actually going after uh, tax frauds and tax cheats and people who are trying to enforce the tax laws, not somebody who is, let's say, skirting on the edge or maybe even past the edge of following them. The EPA administrator, I fear that he is going to not just me, many of the pundits are going to try to dismantle the landmark climate regulations, which I think is a problem. Secretary of Energy, a little bit of the same thing. He's an oil and natural gas fracking guy. The Secretary of the Interior, who is what's he oversee? 500 million acres of national lands, the forests, the parks, coastal areas. And a lot of people are fearing that he is going to open up many of these pristine areas for oil use. And this also kind of scares me. I love national parks. I spend a lot of time in it. I'm in Tucson. I spend the winters 2.2 miles from the national park. And I probably go there more days than I don't. So this is also a little bit of a personal issue for me. But I do believe in climate change, and I think that we have some scary appointments. I won't even talk about the Secretary of Defense nominee. We're talking about managing 2.3 million people, a budget of 8.5 billion. And he's even controversial among the Republicans, and there's a reasonable chance he will not be appointed. Secretary of the Navy has no military experience. He's never worked for a large defense contractor. I think there's some bad stuff going on in the world. And to me, I want an experienced veteran in there, not somebody with no military experience and never working for a large defense contractor. My personal views. Now, interesting, I want to try to be as objective as I can. So we have Elon Musk and Vivek, who are going to be part of this new department, which President Trump calls the Department of Government Efficiency. And one of the Wall Street Journal editorials thought that this is the best appointment that President-elect Trump made. And who knows, maybe they're right. Maybe they're going to make everything much more efficient. The only thing is, you have to be a little bit careful. So the area that I might know the best is the enforcement at the IRS. It takes years to train those agents, and particularly in the estate planning area. And the IRS is tremendously efficient in terms of number of dollars spent on the IRS and number of tax dollars collected. And to me, you want experienced veterans who know what they're doing, and you need to have a continual flow. And the last time they had, significant layoffs at the IRS, they lost a lot of experienced people. A lot of the younger people lost their motivation, went into the private sector. So massive layoffs at the federal level. Maybe they will work. I'm a little bit skeptical. I literally don't know. I, along with everybody else, joke about government efficiency, but I'm not sure that Elon Musk and Vivek are the people to do it. But maybe they are. Maybe the Wall Street Journal's right. But another article was talking about massive conflicts of interest, particularly with Elon Musk. So Now, there are a couple reassuring picks. Scott Bessent for Treasury Secretary, he has relevant experience. And he's actually reassured a lot of the pundits. I think he has a tough job coming up. We have, what, a $36 trillion deficit right now. I'm sorry, national debt right now. Some of the pundits are saying another 15 trillion by the end of the decade. He has his work cut out for him. I think President Trump fired a couple of these folks in his first term, including, he didn't fire him, but he said all kinds of nasty things about Jerome Powell, the Federal Reserve Chair. One thing that reassured me is that he said that he's going to leave that pick alone. That term runs until January 2026. So there are some reassuring areas very important, certainly in financial terms, for the cabinet. So it's not all black and white. But I guess my point is that we are entering a period of volatility and uncertainty. Again, President Trump himself is unpredictable. Supreme Court is giving him more power. We have court decisions giving more power to the to the courts rather than the agencies. And we have these non-traditional nominees that will presumably be in charge of these, really massive agencies like the Army and the Navy and healthcare, et cetera, et cetera. So I've tried to read everything I can in terms of what is likely to happen. And of course, as you would imagine, there's people that disagree, and not just politically, but on what and why they think different things are going to happen. And I'm going to be very straightforward with you. We are guessing. I'm going to give you the best thinking that I have about what's going to happen with inflation and tax rates and things like that, that I believe is very relevant for the issue of Roth IRA conversions. Should you convert? When to convert? How much to convert? But frankly, if these things were a certainty, then we could do the math, because I'm a big believer in math, especially when it comes to Roth IRA conversions, because I don't think it's a matter of opinion. I think it's a matter of math. On the other hand, we have all these uncertainties. So I'm just going to do the best I can with no promises that what I'm saying is actually going to happen. Because the truth is we are really guessing. A couple of my personal beliefs: I do believe in math. I do believe in science. I do believe in the peer review process, which is one of the reasons why when I have some ideas, rather than just saying, okay, here's my idea world, what do you think? I like to go to a peer review journal like the CPA, the Tax Advisor, which is the top peer review journal for CPAs. And again, they have these number crunching CPAs pouring over every word, every dollar, every calculation. When you write for them, you not only have to send in the written word, you also have to send in all your spreadsheets and where you got every single number. And to me, that helps. It helps me know that I'm right, and people that know what they're doing are reviewing my work. And it also hopefully gives you some reassurance. Oh, Lange is talking about some not standard ideas, but gee, they pass the scrutiny of peer review. And I do the same thing in the legal area. The other thing I'm a big believer in is being a true fiduciary, which, to oversimplify, means that we put our interest, or we put your interest, is a better way of putting it, above ours. That's one of the reasons we don't sell those high commission annuity products. And I give a lot of advice that is against self-interest. I'm not 100% sure that the new government necessarily follows some of the things I'm talking about in terms of fiduciary, in terms of peer review, and believing in math, science, and having relevant experience. To me, for the work that we do doing these Roth IRA calculations, we need to start with a CPA with maybe 5 to 7 years of income tax preparation. Then there's like a 2 or 3 year internal process where we're training that CPA to do the kind of work that we do. So this, we're getting people who really know what they're doing, looking at your information. And to me, that is part of having relevant experience. And to me, we're providing what I believe is cutting edge peer review ideas being calculated by people who are CPA veterans, and then have gone through our own internal training as well as some external training. They go out, and I insist that they take some courses that ultimately lead to some designations. And that to me reassures me and hopefully reassures you, hey, we're really getting the real thing here. So if you are anxious about your portfolio, and I don't want to try to talk about things that I really am not qualified to talk about, although some of you may think that what I just said applies to that also. I'm going to really encourage you to tune in. Hopefully you'll stay for the whole day, but at I believe 4 o'clock, Larry Swedroe, he's Erica will give you all his credentials, but he's written all these books. He's so smart, and he's so on top of things. He is now an independent consultant, so he has no ulterior motive other than to say what he thinks. And what we thought the best way to do it was to have a Q&A. So I really encourage you to follow that one. And by the way, Erica mentioned a couple of the books as bonuses. We have some other really good bonuses, including actually other articles on the same issue, how to respond to the election. And then also we're working on it. I don't want to promise it, but I think we're going to be able to get it, which is, oh, no, this one we have for sure, because we wrote it, is our year-end tax planning letter. Jen Hall did an amazing job on it. And I spent a lot of time adding things to it. So these are some of the great bonuses for those of you who stay till the end. All right, so let's get back into some of the things why I bring up all these things of uncertainty, because two of the really important issues for Roth IRA conversion planning is what is the current, and what are the future income tax rates. Now, obviously, that's going to be different for each person. But that said, we have general tax rates that apply to everybody depending on your income and your tax situation. So that's going to be very important. Inflation is going to be important. So I actually added a section regarding Roth IRA conversions and inflation that I don't talk about. As a hint, I do fear inflation coming up. So let's talk about, let's say, some basic problems that we as IRA and retirement plan owners have. And that is who this workshop is for. It's for people who have, if not the majority, at least a substantial amount of money in IRAs and other retirement plans like 401ks, 403bs, SEPs, KIOs, etc. And what all this money has in common is that nobody has yet paid income taxes on that money, but someday somebody will. It might be you, it might be your kids, but someday somebody will. So what is the biggest tax problem that most of us who are a little bit older and have money in our IRAs and our retirement plans, and let's assume traditional IRAs and traditional retirement plans for the moment, and that is crippling taxes on withdrawal. So this is a lifetime problem with minimum required distributions, and even with Secure Act 2.0 to push off required minimum distributions for a couple of years, depending on what year you were born. That is going to be one of our biggest lifetime tax issues, is these minimum required distributions that are going to be taxable and going to substantially eat up our purchasing power. from our IRAs and retirement plans. And the second longer term issue that I believe most of us have is the wealth preservation and the decimation and the horrendous Secure Act that accelerates the income taxes of our retirement plans, again, IRAs, 401ks, 403bs, et cetera, at our death. So these are two huge tax problems, and I tend to be probably over analytical, and I sometimes don't think of the actual impact that it has on the quality of life of saving what can be tens, hundreds of thousands, maybe $1 million or more in taxes by getting all the planning right. And one of the most important components of getting your planning right, frankly, is Roth IRA conversion planning. And many of you have heard me talk about Roth IRA conversions literally for 26 years. This group, by the way, we had about 450 people register for the webinar. We usually get a pretty high percentage of those folks that actually show up. And we did not use Facebook and some of the other marketing methods that we sometimes use. I just wanted to go mainly to people who have been following us, clients and friends of the firm. So the solution to the income tax while you're alive and income tax acceleration after you're gone, obviously there's multiple solutions, but one of the very important one is a strategically planned series of Roth IRA conversions. And it is potentially the most important action that you can take to protect yourself and your family from excessive taxation that could be avoided with smart planning. And here's the other thing, one of the problems that we face as taxpayers and investors is that we don't really have control of the market. We can guess, and we're going to hear Larry give his best opinion, but the truth is we really don't know what's going to happen. So we try to do the best that we can with asset allocation, asset location, long-term planning, and getting, investing differently from Roth and other things, et cetera, et cetera. But the truth of the matter is we can't control the market. But what we can control is our Roth IRA planning, or for many people, unfortunately, the lack of it, or the lack of doing it well and doing it right. And the difference between doing it well or right and let's call it haphazard planning, again, can just be enormous in the quality of life for you and your children. So someday somebody's going to pay tax on all this money. For years, and it's still the name of my website, I took the traditional advice, hey, pay taxes later. And I used to say, pay taxes later when you were working, pay taxes later after you retired, and even pay taxes later after you died. Then 26 years ago, the Roth IRA came in. Oh, so we had to make an exception. Pay taxes later except for the Roth, because there with the Roth, if you're talking about conversion, you're paying taxes up front. So you're paying taxes now in order to get tax-free growth for later. So we had an exception. And then, assuming we have time, we'll talk about the exception to the exception, which involves withdrawing money from your IRA, paying taxes on it, and gifting that money to your kids, who then use that money to invest in something that is tax-free, like a 529 plan. But the overall point is our traditional IRAs are eventually going to be taxed. And so the tax rates become very important, and the proposed tax cuts, which from my reading, a lot of this stuff is actually going to happen. Being very honest with you, during the debates and during the preparation and before the election, I heard, well, no taxes on Social Security, no taxes on overtime, no taxes on tips. We're going to remove the SALT limitation. That's the real estate deduction, the real estate tax deduction. And maybe even making it, or if not removing, not capping it, but at least increasing it from $10,000 to $20,000. We're going to change the tax credits, no taxes on foreign income. We're going to be able to deduct the automobile interest again. And I'm like, yeah, right, sure. That's these great promises. And now I'm reading, and again, it's hard for me to really know. I'm reading, hey, a lot of this stuff might really happen. So we really might get a bunch of proposed tax cuts. And maybe even more important than all of those is we might have a reduction or even elimination of the sunset provision of the Tax Cut and Jobs Act of 2017. So if you remember in 2017, there was a substantial income tax cut. And in order to pass the law that, let's say, kept the deficit down, this tax cut was supposed to be temporary. And it was supposed to sunset or, let's say reappear in 2026. So I've been saying, okay, let's get your Roth conversions in before 2026 when the tax rates are going to go up again. Well, now, under the current administration with the Republican Congress um, and the forces that I believe are controlling, we might get tax cuts and the elimination of the sunset of the 2017 tax cut and Jobs Act. So we're sometimes, now we have to kind of shift our advice and say, hey, we might have a longer period to do Roth IRA conversions, which is one of the reasons why some of this political stuff really does make a difference and why we just can't ignore it. Because, before, where I was saying, okay, hurry up and do your conversions before 2026, I'm now thinking, hey, we have an extension. We might be able to get our conversions in up until 2028, which will be the end of the term, when many fear we're going to significantly increase the deficit. And how are you going to, ultimately, nobody's been successful in reducing spending. So some people think, and by the way, when I poll people, most people think that tax raises are inevitable, which I do believe, but I'm thinking later, not sooner. So I think that we could have low tax rates until 2028. And, again, if you follow some of the reading about the deficit, and again, there's 100 people, 100 different opinions, but I think a lot of the people who I respect, including the Wall Street Journal, by the way, who I would say is traditionally, let's say, conservative, they are predicting that with these tax cuts, that very well might happen, with the extension of the Tax Cut and Jobs Act of 2017, that the deficit is going to be increased by trillions of dollars. And if that does happen, do you think that we're going to have a tax increase, let's say in 2018 or beyond? My best guess is yes. So this does have an impact on Roth IRA conversion planning. The Peter Institute was talking about inflation with some of the policies, specifically tariffs. And tariffs are supposed to replace the revenue lost in taxes. By the way, it used to be the Republicans that were against tariffs. I've never been, and I understand the use of tariffs to, punish bad behavior, but for, having very significant tariffs for our countries that we trade with frequently, even like Canada and Mexico, who we're not trying to punish, to me is kind of a scary thing. Some people call that a hidden tax increase because ultimately the consumer is, it's not like the other countries are paying it and not raising their prices, and the suppliers are not raising their prices. It's ultimately the consumers. So I think that we can expect some tax increases in 2028 that will presumably help with the significantly increased deficit. So, and again, I hope I'm wrong. I genuinely do. I hope, Elon Musk cuts, government waste and we're a lot more efficient and that I'm wrong. But I do fear inflation. I do fear an increase of the deficit. I do expect tax rates to continue to be relatively low, but at some point in the future, I expect them to go up. And if we can get our Roth conversions in before they go up, we are talking about a massive tax savings for ourselves and our family. So, everything else being equal, the old thinking was get your conversions in before 2026. Now I'm kind of shifting my tune and saying get your conversions in before 2029. That is, we have a longer period of time to convert because we have lower tax rates in the short run, higher tax rates in the long run. By the way, this is general information. So each person has to not only look at the general picture, but their own situation, like when their minimum required distributions are coming, when are they going to have capital gains, what's going on in their careers if you're still working. All the other tax attributes have to be taken into account, which is one of the reasons to me why you need seasoned CPAs to do these calculations, because they start with doing tax projections. And I don't want to, berate a whole group of people like financial planners, but they don't have the tax training that CPAs have. So to me, to do this work really well, you have to, do CPAs. Jen Hall genuinely believes to do this work right, you not only have to have that background, but you actually have to do tax returns. So all of our number crunching CPAs who are doing this highly sophisticated work, they're also still preparing tax returns. And when I propose, hey, maybe it makes sense not to prepare tax return, maybe we should do all this sophisticated work, despite the fact that they like doing this sophisticated planning more than the tax returns, they're saying, no, 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 we actually need this kind of work to really do our best. So we are going to be recommending being proactive, defend yourself against the deadly Secure Act, because otherwise you're going to get decimated. Okay, so that's, let's say, the introduction of the big picture, but let's go into what we're going to be talking about and learning, which is, and again, I'm not going to give you, well, it is my opinion, but it's been peer reviewed by the American Institute of CPAs, both the methodology, now the numbers have obviously changed since I've done those articles, so we're using updated numbers, but it is a peer reviewed concept regarding Roth IRA conversions. And it is amazing to me how few people, including some of the so-called experts, don't really understand what we're going to be talking about. And by the way, I've been talking about this since 1998, and I've taught this to thousands of financial advisors, attorneys, and end consumers like you since 1998. And many of you have been following me for many years, and you're thinking, oh no, he's going to talk about The Secret again. And yes, I am. And again, I don't think you can hear that too often because it's just so critical to understanding wealth for IRA and retirement plan owners. We're going to talk a little bit about the Secure Act. We're going to talk about some of the advanced Roth techniques. I hope to have time for that. That's one of the reasons I'm speaking quickly. But we have some really cool advanced Roth techniques that hopefully I can talk about that go well beyond the basics that hardly anybody knows, even the CPAs and the people who are doing this kind of work on a regular basis. It is surprising how many people have interviewed me and they didn't know anything, excuse me, about some of the sophisticated techniques that hopefully we will have time to get to. Okay, so Now let's go to the essence of Roth IRA conversions, which is you're taking a retirement plan. When I say Roth IRA, I will also extend that to Roth 401k, Roth 403b, SEP, KEO, etc. You're taking one of these types of assets. And remember, nobody's paid income tax on that asset. And what you're doing is you're transferring, you're filling out certain paperwork, and now that asset, let's just say for discussion's sake, that for simplicity, it's a $100,000 in a traditional IRA. And we're going to say, okay, we're going to pay the taxes on that money now, which goes against the old rule, pay taxes. So we pay the taxes on that money now. Let's keep life simple. Let's assume a 24% tax rate. And let's forget about all the complications about the additional income raising the tax rate. Let's just keep it simple. So we're going to pay $24,000 upfront. Now we're going to take that traditional IRA and we're going to make it a Roth IRA that is going to grow income tax free for the rest of our lives. It's going to grow income tax free for the rest of our spouse's lives if we leave the money to our spouse, and subject to exception, another 10 years of tax-free growth for our kids after both we and our spouses die, and ultimately that money goes to the kids. There is no required minimum distribution for either you or your spouse, which is a big deal, particularly for people who are IRA heavy. And it's a really big deal for people whose minimum required distribution and Social Security and passive income exceeds how much money they're spending, which is a lot of my clients. So that a Roth IRA conversion will cut future minimum required distributions. And that is critical when we run the numbers to take that into account. Yes, there are required minimum distributions of inherited IRAs or even Roth IRAs after death, but the inherited Roth IRA distributions, including the ultimate disposition 10 years after death, is all income tax free. So in my case, I did that conversion 26 years. Let's say my wife and I live another, say, 30 years. And then because our child has a disability and she can stretch that inherited Roth IRA over her lifetime, we might get, I don't know, 70, 80 years of income tax-free growth. What a huge difference that makes. And in my case, with a daughter with a disability, and that's one of my main concerns, is providing for her not only while we're alive, but after we're gone. In effect, it's kind of like a transfer, which is what I'm all about, a transfer from the IRS that would have got the money to our families. So that introduces the concept of the secret. Again, I've been teaching this for 26 years. Concept hasn't changed. The numbers change a little bit with taxes, but here it is, the secret. And by the way, as recently as yesterday, I asked a really smart financial advisor to review my slides to kind of as a double check. And he made a comment that indicated that he didn't really understand this. And because of that, he was giving people wrong advice. So this is a critical. So even if you've heard this 10 times, this is an important concept. If you haven't heard it, might be a little bit difficult, but I think it is instrumental to understand not only Roth IRA conversions, but to understand the nature of when we have substantial IRAs and retirement plans in our portfolio. So the secret is a not new, but let's say a different measure of wealth. So traditionally, the way we measure wealth is in total dollars. All right. So let's say that I have $1 million in an IRA and you have $900,000, but your $900,000 isn't in an IRA. Let's call it a plain old brokerage account. I have more money than you, right? I have $1 million. You only have $900,000. But what I want to do is I want to measure in purchasing power. How much much stuff can I go out and buy with my $1 million IRA? Well, let's keep it simple, not get into some of the complications that make what I'm saying mathematically not quite accurate. But let's say that I pay 24% taxes on my withdrawal of my IRA. I only have $760,000, so I can only go out and buy $760,000 worth of stuff. And let's forget about capital gains for a minute. You have $900,000, which is less money than me, but you can go out and buy $900,000 worth of stuff. So what I want to do is I want to include purchasing power as our measurement tool. Is everybody okay with that so far? By the way, if you could put that in the chat, just so I have an idea that yes, people get the idea and are willing to suspend total dollars as our measurement tool and are willing to substitute purchasing power as our measurement of wealth. Maybe Eric can report back to me, but it would be helpful to me if you were to say, hey, yeah, Jim, I get that, because that concept is important to what we're going to talk about. So let's assume that we agree with that. And what I want to do is I want to actually go to mathematical proof on that. So let's use $100,000. We both start with $100,000 of a traditional IRA, 401k, 403b, SEP, etc. We each have $24,000 of after-tax dollars, right? And let's keep it simple. That's all we have. So both you and I have $100,000 in our IRA. We have $24,000 outside our IRA. So our total dollars, measuring wealth in total dollars, we each have $124,000. Now, let's say, and again, if you could put this in the chat, do you want to be Mr. Status Quo and sit on your $100,000 and your $24,000, invest them both and have them both grow? Or would you rather make a Roth IRA conversion where you're where you're filling out certain paperwork, your traditional IRA becomes a Roth, whoever you do the paperwork with then sends you a 1099, says, please add another $100,000 to your taxable income in the year that you made the conversion. And again, to keep it simple, we're going to have a $24,000 tax on that $100,000 of additional income. So now you're using the $24,000 that you had in your after-tax dollars to pay that tax. So now your after-tax dollars are zero. So now you have $100,000 in your Roth. Now I have $124,000, but it's $100,000 in my traditional IRA, $24,000 in my after-tax dollars. So I have more money measured in total dollars than you. But now let's take a look and measure in total purchasing power. So even though I have $124,000, if I want to go out and buy something, I have to cash it, my IRA in. I have to use my $24,000 of after-tax dollars to pay the tax on the withdrawal of my IRA. So I can only go out and buy $100,000 worth of stuff. You have $100,000 in your IRA, but you don't have any after-tax dollars. But when you go to cash in your Roth IRA because you want to go out and buy some stuff, you don't have to pay any taxes. So if you measure in purchasing power, the day that we made the conversion, we have the same purchasing power whether you do the Roth or whether you don't. We'll get into what happens in future years later. But do you see measured in purchasing power, we assuming the same tax rates, we break even on day one. And so many of the so-called experts don't understand this. And if you measure in total dollars, the conclusion is that Roth conversions are not great for older people because it takes them so long to make up for the $24,000 that they had to pay in taxes, but it's good for young people. But if you use purchasing power, then you get a completely different set of recommendations on when and how much to convert, right? I've been rambling on for a long time. I think that you might need a little bit of a rest from my voice. I'm going to ask Erica if we have any questions so far. I'll take a few questions and then I will plod on.
We do have a lot of questions, and actually I'd like to start with two that are kind of a corollary. Well, they kind of go together. One was submitted in the Q&A feature, which I would just like to remind people is the easiest way to get your questions answered is to put them into the Q&A rather than the webinar chat. But this, the first question is about Roth instruments, and it's one that Jim gets a lot, and I think it's actually a really important one, especially in the context of a workshop where we're talking about the way that politics and the legislation that comes from administrations can change and impact retirement planning for people like us. So the question that we got in the chat is, can politics change the rules on Roth being tax-free, affecting us retroactively? And the question that we got in the chat that was a corollary to that was, unfortunately, almost all of the arguments for Roth conversions are based on assumptions that could change, just like investing in general. So, Jim, could you speak a little bit to the way that the tax-free structuring of Roth is actually done and how it is and isn't different from other instruments like Social Security and the rules that dictate that?
Them rascals in Washington, they promised us no tax on Social Security. Then what did they do? They taxed Social Security, and there wasn't a darn thing that we could do about it. How do we know they're not going to do it again? And particularly after what I just said about the increased unpredictability. And there are a few words about, not even of really making significant changes to the tax system. All right, well, what about the Roth IRA? What if they just write a rule that says, hey, we changed our minds, Roth IRA conversions are taxable? The reason, and there's no 100% guarantee, but I would say it's in the high 90s, maybe 99 or more, is it is part of the code, the Internal Revenue Code. So this is the law, and it's pretty unambiguous that Roth IRA conversions will not be subject, and when you withdraw the money from the Roth, that other than the 5-year rule, which I don't want to get into, that money will not be subject to income tax. So again, that is part of the code. And to, Erica, you mentioned retroactive. To retroactively change the code, that is a violation of due process. It is a violation of the Constitution. And in addition, I think you would have a very well-funded revolution because many people have relied on the tax-free future of Roth IRA conversions, relied on it. So we have what is called detrimental reliance. We have the constitutional guarantee. We have the statutory guarantee. So again, nothing is totally impossible. But with Social Security, they changed their taxation of Social Security. They're talking about doing it again. That was never part of the tax code that we will never tax Social Security. What that was the legal word for it is dicta, meaning it is something that a president, a legislator, a judge, somebody said, but it doesn't have the force of law. Why don't we take one more and then we will move on. But anyway, of all my fears, the retroactive, all of a sudden starting to tax Roth IRA conversions is not one.
Thanks so much. And I just wanted to say, everyone, I really am trying to get to absolutely as many questions as we can. I am trying to preference the ones that came in earlier. And this is actually the first question that we got from Richard. he said, what circumstances might make it advantageous to continue making Roth conversions after the required age of 73? Now, I'm not sure what he means by required age, but after 73.
Well, first, so I think what he's referring to is, depending on what year he was born, if I was a little bit sharp, I would know off the top of my head. I guess it's somewhere around 50, 56 or 57 or 55. But anyway, that is the new minimum required distribution year. It used to be the year after April 1st of the year after you turn 70 and a half. So what he's saying is, okay, I missed my window, or maybe I had it, but should I be considering taking additional Roth conversions, even though I am taking my minimum required distribution now? So now he has his minimum required distribution, he has his Social Security, and maybe any other income, whether it be a pension or dividend and interest or capital gains, et cetera. And then he's going to be making a Roth IRA conversion on top of that. And he's saying, hey, are there circumstances when it still makes sense to do that? And the answer is, earlier, before we had some of this, and particularly before the Secure Act, and before we really took into consideration not only your life, Richard, but also if you're like most of my clients, you're not going to die broke. You're going to die with maybe more money than you have now. That's what's happening right now with most of my clients. They have more money than they did 10 years ago, even if they retired 10 years ago. But anyway, it might very well make sense for you to do Roth conversions. Jen would kill me if I said anything else, that we have to run numbers for your individual situation, and she's right. But I will tell you that we are doing a lot of conversions for people who are already taking their minimum required distributions. Ideally, you would do it maybe before, but sometimes you don't get the opportunity. People are working longer. And the other thing is, if we look at we're not just looking at your tax rates now, we're looking at your future tax rates. And if you have a big IRA, your minimum required distributions are, even if the market just does okay, are getting higher and higher and higher. So just that alone would push you into a higher tax bracket. And the other thing is, I think, being realistic about how much money you have total, how much money you're likely to spend during your lifetime. And if we are being, I think, really long-term planners, doesn't it make sense for at least a portion of the money to, rather than using our and our spouse's life expectancy, but maybe to use the life expectancy of our kids, or in some cases our grandkids? Well, let's just keep it one generation for the moment, our kids. And it might very well make sense to do Roth IRA conversions. One of the big things I love to do is multi-generational planning. And sometimes I'm having people make very significant Roth IRA conversions, even though it's not going to make any difference in their lives, but it will make an enormous difference for their kids. By the way, that's one of my favorite areas. I love to be able to give advice if some of my clients have a living parent on what the living parent should do. So that also makes sense. And by the way, it's never too late. We have actually recommended and overseen multiple, actually many times, well, not that many, but I've recommended it many times, but I've actually overseen it in a bunch of situations where we did what we called a deathbed Roth IRA conversion, including one that was literally done in the hospital bed. And that family will be more likely hundreds of thousands of dollars better off because we got that done. So the short answer is yes, after minimum required distributions, it very well might make sense to do Roth IRA conversions. And again, I want to get through a certain core material. If we have time for additional questions, which I hope we will, we will take them. But I do want to move back on to because where we left off was, okay, assuming the same tax rate, we break even on day one. So I'm not going to have you write a check for $24,000 to break even. That doesn't make any sense. what makes more sense is, okay, we're going to break even for day one. But what happens if we're not measuring for day one? What about day two, year 20, year 40 after the conversion, and even beyond our own lifetime? So why don't we do this? Why don't we call it running the numbers, which is done by our sophisticated CPAs. Again, the numbers that I'm going to present are not peer reviewed because they're very recent and take into consideration, by the way, they take into consideration the existing tax rates. If I'm right that the tax rates are going to go up in the future, then the savings will be even greater. But let's just take a look at this. And by the way, for those of you who want all the assumptions, that this can be found in the book Retire Secure for Professors, which is one of your bonuses. Gee, it's only 500 pages, but luckily it has a 20-page table of contents, so you can go directly to the area that you want. And even though there was a couple chapters specifically for professors and TIA participants, there's a lot of very good information in this book. And again, if you stay till the end, the hard copy, because most of us are a little bit older, and even though our kids might like the digital versions, at least I still like a hard copy where I turn the pages and I underline things and I highlight things, et cetera, et cetera. So anyway, let's run the numbers. And what we're going to do is we're going to measure in purchasing power. We're not going to measure in total dollars. Okay, so let's do a series of conversions between retirement and age 73. Again, that's going to be the new required minimum distribution date for many of us, compared to not doing the conversion. So if we're not doing the conversion, we have more total dollars because we're not writing a check to the IRS to make the conversion. So the difference between just doing this series of conversions and not, I would say is life-changing. Measured in today's dollars, and it wasn't exactly maximized, but let's just, in this example, we did conversions of $175,000 a year for 5 years. So one of the reasons was we were trying to keep, we didn't want to go into too high a tax bracket, but a lot more goes into it than just the simple tax bracket changes. But we did these conversions, and that is in the solid dark line versus, and it's in the serrated line, we didn't do the conversions. And we started again at 65, and we kept them up, until minimum required distribution. Actually, I guess that would be 7 years. But anyway, there's, measured in today's dollars, there's about a $270,000 difference. Think about how hard you had to work to accumulate $270,000 after taxes compared to just getting the Roth conversion feature right. Yes, we have time at our, working for us. And in this example, I'm assuming that you're going to live another 20 years. But, it's just a huge life-changing. I mean, when you only have, let's say your total wealth is, in this case, we're just looking at the IRAs, but let's just say $2 million or less, and you're going to be better off by more than 10%, that's pretty significant. But again, I'm looking for multi-generations. So I'm going to assume that you made this series of conversions, and then you and your spouse died at, let's say, age 85. And let's say at that point, your kids are in their mid 50s. And in the black line shows the natural trajectory of the balance, measured in purchasing power for you who made the conversion versus the measurement in total purchasing power of the child of the person who didn't make a conversion, and you'll see that that person's child runs out of money at roughly age 81, where the child who had the conversion, they still have close to $2 million. So, and in today's dollars we're talking about. So this is not just a little thing. This is a very, very big thing. And I really want people to get this right. And again, this is something that you can control. And by the way, we've been on top of this Roth issue for 26 years, and I'm really happy to report that so many of my clients under our direction have made these Roth IRA conversions, and they are so much better off. And frankly, many of you have clients and people who have just been following us. So again, I tend to get mathematically oriented and talk about the numbers and, oh, look at this chart, look at that chart. But the difference between being, later in life, the difference between being broke and having $2 million in today's dollars, this is enormous. And this is something that we can do for ourselves and for our kids. Again, so one way to look at it is if you had a seed, if you pay tax on to buy the seed and it grows tax-free, that's like a Roth. If you get a tax deduction for the cost of the seed, but then when the harvest comes, it grows income, you have to pay tax on it. That's a little bit like the Roth IRA, where you only have to pay tax on the seed and the harvest comes tax-free, which is, let's say, a non-mathematical way of thinking about it. So this relates to the question that we had from Richard. All right, so ideally, you convert when your tax rates are low. So let's say you're working, your tax rates are up here, then you retire and you're holding off on Social Security, which we'll talk about a little bit, and your tax rates go here. And then you're going to collect, in the future, you're going to collect your required minimum distribution, and both you, maybe your wife or husband also are collecting Social Security, so your income goes back up here. Well, down here, if you're in that fortunate situation, and particularly exacerbated or improved by what we think is going to be the extension of the Tax Cut and Jobs Act of 2017, where before we thought we were going to sunset, that's like the classic time to make a conversion. That is ideal. But what we are finding, based on a lot of factors, when you run all these numbers, and particularly if we're using the life expectancy of our children for our measurement. So a lot of the numbers we're finding is, yes, the parents are maybe a couple $100,000 better off, but the kids are even that much more better off. And if tax rates go up like I fear, then the benefits are going to be even greater. So we are finding that sometimes it makes sense for people who are still working to make conversions. Sometimes people's income is higher when they're working, when they're retired, between their Social Security and their required minimum distribution, than they were making after paying all their taxes. And it's something that people didn't expect. And they also kind of expected their portfolio to go down after they retired. And most of our clients, and it's not because we're such brilliant investors, it's because of the nature of tax compounding, and better yet, tax-free compounding with the Roth, their portfolios are actually going up, even though they have retired 10 years ago or more. We've talked about the sunset provisions and the tax rates. Also, by the way, in the estate tax exclusions, we're going to cover, let's call it the latest and greatest in estate planning in our next session, which I believe starts at 12:30. Eric, correct me if I'm wrong on that. I'm not going to get into all the political stuff and the appointments and all that. Again, I'm just going to go straight into the material. But the short answer is we don't think that the sunset is going to happen. So as you know, even this year, I said, hey, do the conversions, and in 2024, 2025, when the tax brackets, which I show here, are much lower, using the example, well, you could, now you could go up to $383,000 and still be in the 24% bracket, where in 2017, and presumably what we thought was going to be 2006, now we're saying 2009, that would take you into the 33% bracket. So we said do the conversions at 24%, so you're saving tax at 33% later on. Again, I bring this up, and I did some of that analysis to give you some better sense of whether you think tax rates are going up or going down. And frankly, both the presidential, and the Congress, and the appointments in the courts all lead me to think that at least for the next 4 years, our tax rates are going to stay the same or even go down. But ultimately, I think we're going to have to pay for this deficit, and it is going to go up, which means that we're looking. The Roth IRA conversion is really a long-term strategy. And by the way, I'll tell you, and by the way, I'm not selling Roth conversions. I'm trying to give you the best objective advice I know. I will tell you one downside of it is that people, including my wife, because our Roths are well into the 7 figures right now, she would rather eat rice and beans than spend a nickel of that Roth. In her mind, that Roth is for our daughter. And since, by the way, our daughter does have a disability, unless there's going to be other changes that I don't think are going to happen, she'll be able to stretch that inherited Roth IRA for her entire life, just like we used to before the dreaded Secure Act, which I hate and will always hate. And by the way, President Trump signed that, so we can't be 100% certain that he's only going to do things that are going to be tax favorable, because to me, and it was such a betrayal, because the government said, hey, they didn't say we guarantee we will never tax something, but they basically said, the rules are your kids are going to be able to stretch that inherited IRA over their lifetime. And then after you dutifully put so much money into your retirement plans for so many years, late in the game, the government says, we decided we're going to tax them. Again, they got away with it because it was never part of the Constitution. Well, it was never part of the Internal Revenue Code, that going retroactive would be a violation of the Constitution. So if you think that tax rates are eventually going to go up, then that's going to be an additional reason to make a Roth IRA conversion. And here's another factor and a concept that many of you won't accept, many of you will. I think that Roth IRA conversions, how much and when to convert, is essentially a math problem. All right. It's not you like Whitney Houston, I like Barbra Streisand. We can argue about who's the better singer, and each of us can be perfectly legitimate in our opinion. The issue of how much and when to convert, it's math. Now, what are some of the variables that we can't control and that we don't know? Well, future tax rates, both in general and our own particular tax rates, what the market is going to do. But if we knew those kinds of things, and also sometimes what state you live in makes a difference. But if we had all that information, we would be able to calculate this. There's a lot of tax calculators out there. I don't like them because most of them don't really measure in purchasing power. And the other thing that they don't do that we do is that you could look at every single number that we use, and each number has its story, how it's taxed, et cetera, et cetera. So we have tracks, or a lot of the software, you don't know where the money, the calculation is done. Will that be able to change with AI? Yeah, somebody's probably going to figure that out. And by the way, when they do, we want to be the first ones to be on top of it. But and there is, you know, there are issues that people will say. So the assumptions are important, but understanding it's still ultimately a math problem. And your particular situation, we might want to change the assumptions, like if you're going to get more money or less money, or you're going to get divorced, or you're going to get married, or your kid is going to need a chunk of money for college, or a grandkid for more of us, particularly these days, are going to need the money for all that stuff. All that changes the assumptions. It doesn't change the fact that it's still a math problem. And that's why I like peer review, and that's why I like math and science, because I don't think it's a giant mystery where we have reasonable people. You can have reasonable people disagreeing on the assumptions, but once you have the assumptions, it's math. Okay, I'll get off that bandwagon, but I really believe that, and it's very frustrating to me to hear so many of these pundits talk about it as if, well, I like red, you like blue, we can each have our own opinion. No, this is math. The assumptions change, but it is math. And my situation is different. I don't go for that, because my situation is different to me just means you change the assumptions. Oh, Jim, both of us have a bad history in terms of life expectancy, and we don't have any kids. So therefore, does Roth IRA conversions make sense? Well, maybe not, but that's because now we're changing the assumptions, and we're changing the, let's say, investment period that will change the result. So I hear that. I hear people use rules of thumb, like, oh, I'll go up to this bracket. But if you want to get this right, doing the math yourself is not easy. A bunch of people try, and sometimes trying you get better results than nothing. Sometimes it's worse results than nothing. But in my opinion, it's whether it's you or a real expert who does these calculations, not some computer program that we don't know where they got their numbers, not somebody who thinks it's a matter of opinion, but somebody who really gets it doing these calculations. And to me, it's something that you can control, and it is a wonderful way to provide for yourself and for your family. And the other thing is, if going by measured in purchasing power, in effect, people say, oh, it's cost me $100,000 to do a Roth conversion. Well, if we're measuring in purchasing power, it didn't cost you anything. And this is something, forget about your kids for a moment. Yeah, that's a great reason to do it. And you might do a bigger one thinking about your kids, but you yourself, given most assumptions, will be better off by doing a series of Roth conversions than not. The methodology, again, peer reviewed. It was the first article in the country on Roth IRA conversions by the tax advisor. And by the way, they are a serious peer review journal. I mean, not only did I have to submit, all the words, I had to submit. And back then, they didn't have all the great software they have available now. We did it on Excel. We were doing the calculations for our clients in Excel. It's 10 times easier now. It still takes us, about 6 hours to do a review. We'll get into that, but it's not easy work. But to do it right. But they went through all of that. And then, by the way, there's a little plug for the next session. I put in my favorite estate plan, which kind of didn't belong in a Roth IRA article. But I thought, I'll throw it in there, see what the peer reviewers said. And I thought they were going to come back and say, hey, this is a Roth article. Take your estate planning theories and do some other article. Instead, they loved it, and they asked me to expand on it. And by the way, that is what we're going to be talking about at the second session, which I believe starts at 12:30 Eastern. So that's, there's certainly nuances that have changed. but that same basic idea of what I consider the best estate plan for married couples, it was peer reviewed back in 1998. And by the way, it has gained massive popularity since then. But I want to stay on Roth for now. Couple issues that we don't really think much about. If you're married now, one of you is going to die first. Occasionally there's a simultaneous death and people always ask about it, but usually there's a death and then there's a period of at least a year, often longer, sometimes much longer, until the second person dies. But if you're in that situation, you're likely filing your taxes, married filing jointly, which has a much lower income tax rate than single, which is how the survivor is going to have to file the year after death. So, and usually the income doesn't change all that much. Minimum required distribution tends to be similar. Yeah, we're doing one Social Security, not two, but it's the higher of the two. So a lot of times we don't have that big of it in the investments or the investments. Maybe we have some money going to the kids at the first death. We'll talk more about that. But the income doesn't necessarily change that much, but the bracket does. So I like to do the conversions while you're both kicking. So Secure Act, miserable, miserable piece of legislation. Let's talk about dying with $1 million the day before the Secure Act was effective. So you die on December 31, 2019, and let's just do some assumptions, which, by the way, again, can all be checked in this book. And this listening to this talking head might be tough enough without me going into all the assumptions. But anyway, you end up, I'm sorry, your kid ends up out of money, let's say when they are age 86, using those same assumptions, but let's say, oh, I'm sorry, you died, the serrated line died January 1, 2000, and the solid line was December 31, 1999. So I got $2 million difference. So this is enormous, and subject to exception, this is what we have to face, and Roth IRA conversions are one of the things that will reduce the impact of the Secure Act. Some of the exceptions, if you leave the money to your spouse, thank goodness, or a disabled or chronically ill beneficiary known as EDB, like my daughter, they can use the old law, which was very, very important. And by the way, that's another major bandwagon of me, is helping parents with a child with a disability like mine. And I even wrote a dedicated book on it and brought in some wonderful co-authors. And there's some other exceptions that I don't want to get into. But again, Roth is the answer to this massive, or one of the answers to this massive income tax acceleration of the inherited IRAs and retirement plans at death. Because with the Roth, there is no income taxes at death. And you get at least 10 years of additional tax-free growth, but there is a potential, although there is going to be minimum required distributions depending on how old the decedent was when he died, and then the money comes out. It all comes out after 10 years, subject to exception, but when it comes out without an income tax. Okay, I'm going to get into a slightly advanced issue, which is, oh, gee, Jim, if I do a big Roth conversion, or sometimes even a small one, that's going to increase my premium for Medicare Part B. So therefore, I shouldn't do that. Now, I've been speaking every year to the Westinghouse retirees. One of them came to my workshop well more than 20 years ago, really liked it, said, oh, you have to come to the Westinghouse Shore Group. So, and I've been doing it year after year, and I love those guys. Very smart, these kind of, now, of course, they're older and they're starting to die. But, these older, very smart, very nice people, mostly engineers, mostly men, some women, but they love Roth conversion. They get it and they're excited about it and they love when I talk about it, and many of them are doing it. But they hate paying higher Medicare premiums. So for them, it was almost a religion. Okay, I'll do a Roth conversion, but I'm not going to convert an amount that will throw up my Medicare Part B premium. So that was just their mindset. And I'm not saying that they're all wrong, but here's what they didn't necessarily consider. They didn't consider if you make a Roth conversion, then that money isn't subject to minimum required distributions in the future. So that means that, yes, you're taking the hit now and your Medicare Part premium might go up, but later on, you're going to have a reduced minimum required distribution. So your Medicare premium might be even lower than if you did nothing. And sometimes they don't take that into consideration. The other thing they sometimes don't do is, and by the way, a lot of them do get out the spreadsheets and et cetera, but they stop the analysis at their spouse's death. They sometimes don't take into consideration the higher rates being at single, but realistically, most of these folks are not spenders. They're not going to die broke. The Roth is going to survive them and their spouse. So maybe it would be more appropriate to use the measuring life of at least 10 years after their death, if not for the life expectancy of their child. And if they did that, I think that they would come to different conclusions. It's something we always consider, but don't just automatically assume because you're going to bump up your Medicare Part B premium that you shouldn't do a Roth IRA conversion. Let's see. How are we doing on time? Do we have time for a few questions, Erica? Or are we?
I wish we did, and we have so many great questions, and I really am reserving them for the session with Larry. I know it is scheduled for an hour, but I suspect it will go over a bit because Larry loves to answer questions, as do you. Unfortunately,
The
I
short
was
answer
actually
is
just about to
no.
cut in to tell you that I need to go over the bonuses so that nobody misses out on the opportunity to get those.
So you're saying we don't have time for questions now? Okay, I
We
get it.
don't.
All right, why don't I just go on for a couple of things? And by the way, I'm looking at the time now, so it looks like I don't have a lot of time. I've taken a little bit more time. I even rehearsed it, and some reason it never works out. And I've been trying to speak fast. But there's a couple things I do want to cover. I'm not going to be able to cover the whole program. By the way, if we can potentially make some prior programs available, and most of the information is in the book. I wanted to address, though, inflation and Roth conversions. Here's the thing, and I'm going to oversimplify this. Inflation was on, everybody's mind, and it might have been the reason why President Trump won the election. But what is the impact of inflation, which I believe is going to still be high, on Roth conversions? Again, I actually think that global forces are more important than what a president can do. But some of the things that we are talking about, it looks like it's going to lead for inflation, increased deficits, tariffs, tax cuts, the immigration policies that I don't think it's going to be 20 million, but I don't think it's going to be insubstantial, reducing labor availability. All these things, perhaps tariffs being one of the most important, if not the most important, that is likely to increase inflation. So if you think there is going to be continued or increased inflation, what are some of the things, how does the math work? All right, and I'm skipping a few slides, which I apologize for, but remember when we did $100,000 and 24,000? Well, let's measure in purchasing power after inflation. So we have after tax of 19.2, which used to be 24. We have traditional IRA of 80, which used to be 100, the same tax allowance. So what you see is if inflation is uniform, it doesn't affect the issue of how much and when to convert. The truth is, and again, I don't have time, inflation is not uniform. It's going to hit certain areas and not hit certain areas. And so there can be inflation for one person and not inflation for another person, depending on what your housing situation is, what you spend your money on, et cetera, et cetera. So I'll just say, I hate to say it, but it's going to get back to an individual situation. But don't say, oh, yes, there's going to be inflation, I should do Roth conversions, or, oh, there's going to be inflation, I shouldn't do Roth conversions, because if inflation was uniform, it would be a break even. And oh boy, I hate going through and missing. I might go a little bit over because there's a few things I really do want to cover. Social Security and Roth IRA conversions, it's synergistic, meaning if you hold off on your Social Security, we usually in short recommend that the higher wage earner hold off until they are age 70 and get those 8% raises, that you also get a chance to do more Roth conversions at a lower tax rate. So the difference between getting Social Security right and getting Roth right is more than just the difference of getting Social Security right by itself or the difference of just getting Roth IRA conversions right by itself. It's a synergistic calculations that can literally be hundreds of thousands, sometimes over $1 million. Even for getting your heirs, with your heirs, it's even more. So I love to concentrate. And by the way, I'm just talking about Roth today. There's so many other issues that play into this. But I can only cover so much, and apparently I am not covering what I really, everything that I wanted to. Let me just do a real quick case study. It just showed the difference between, let's say, and I didn't want to do, oh, this is wonderful, and these other guys are complete morons, and look how much better the ideal is. Let's assume that the status quo is not morons, but let's just say what a lot of people do. They claim Social Security at 67. They continue to put money in their retirement plans, but they figure they're done with Roth. Compared to holding off till 70, doing Roth 401k, not just traditional retirement plan contributions, doing the backdoor Roth, which is another topic we didn't have time to talk about, and then optimizing a series of Roth conversions. And the difference, if you do this over the life of your kids, is millions of dollars. I mean, this is just wonderful. And this is strategy. This assumes the same investments rate, the same tax rates, everything else. And this is the stuff that we love, that we think that we just add so much value when we get all this right. And again, we love Burton Malkiel. What an American hero. And he likes our concepts of Roth. So time doesn't allow, but I have to at least talk about a couple advanced topics. Really cool stuff that we're not going to be able to cover. Converting after-tax dollars inside your IRA or retirement plan to a Roth without having to pay the tax. That's wonderful. The Westinghouse people love this because a lot of them have after-tax dollars in their IRA and the 401k, and they find out they can convert it to a Roth without having to pay the tax. They have to jump through some hoops that I don't have time to explain. The answer is yes. Then here's another really cool one that, so many advisors are so anxious. They say, oh, take all your money in your 401k and your 403b and roll it over to me, and, we'll do much better than the market. You'll be so happy. Well, even if that's true, and I think in most cases it's not, but even if it was, sometimes it makes strategic sense to keep money in a 401k or 403b. So let's say you're in a high tax bracket and your beneficiary is in a low tax bracket. And let's say that you are much older and you're saying, hey, I can convert, but for me, I might be converting at 24, 33%. We're only going to save money. Or my kids' bracket, it might be 10 or 12% or even 0%. Gee, how's the math on that work? Well, not so wonderful. But what if we can have the Roth conversion done not by us while we're alive, but by our kids after we die. Now, you have to be careful. You can't convert an inherited IRA to a Roth after death. But interestingly enough, if the plan allows it, which is another couple hoops that we can jump through that we have done, we can convert an inherited 403B or an inherited 401k to an inherited Roth or inherited 403B, Roth 403B after you die. Really cool concepts. Then I don't have time to go through, let's call it, where we withdraw money from an IRA, pay the taxes now, and then gift that money, and then our kids invest that money income tax free.
Allow me to ask you some important questions. Do you want to protect yourself and your family from massive income tax acceleration? Are you at least slightly concerned that future income and other tax increases will unnecessarily decimate your hard-earned savings and threaten the financial legacy you plan to pass on to your children and grandchildren? Are you willing to take action and defend yourself from government confiscation of your hard-earned money? Are you ready to take proactive steps that could help you and your heirs get the most out of what you've got? If you answered yes, this short video could be the most important thing you have ever watched. Imagine you could wave a magic wand and have a rock-solid financial master plan that has all your financial affairs in order. Think about how you would feel if you never had to worry about money because you had solid data that allowed you to make informed financial decisions, not guesses. How much better would you sleep at night knowing your financial master plan is in place? I'm going to share with you how you can make that happen. But first, let's talk about why it's so crucial to develop and implement your holistic, long-term retirement and estate plan. First, thanks to the sunsetting of the rates set by the Tax Cuts and Jobs Act, it's likely that your current income taxes will go up in 2026. But even if legislation is passed to enshrine the current rates before they expire, raising income tax rates isn't the only way to raise taxes. Jim Lange predicted the death of the stretch IRA and advocated defenses against it more than 5 years before the Secure Act became law. Jim had the foresight that almost no other retirement and estate planning experts did. He understood that the end of the preferential tax treatment of inherited IRAs and retirement plans wasn't a matter of if, it was a matter of when. Now Jim predicts higher capital gains tax rates, changes to federal tax exemptions, elimination of step-up in basis rules, and estate tax increases. Congress pulled a bait and switch on you, and it was just plain wrong. You were promised that contributions to your IRAs and retirement plans would pass to your heirs with significant tax advantages. Remember the stretch IRA? Because you were fiscally responsible, you acted on that promise. You sacrificed so you could put as much money as you could into your retirement plans. Then, late in the game, Congress pulled the rug out from under you by passing the Secure Act. The consequence of Congress's actions with the Secure Act? A massive income tax acceleration on money you thought was protected. But there is a way for you to fight back and protect your wealth from the Congress's greedy hands. We can offer you the means and the tools to pull back some of that money. There is no single strategy that will solve all these problems and ensure your future financial security. Nor is there a one-size-fits-all combination of strategies that is right for everyone. But Jim and his team will help you find the right combination for you and your family. Here are just a few of the strategies in Jim's arsenal. A series of timely Roth IRA conversions to be executed over a number of years. Social Security optimization. Lifetime safe spending analysis. Spend the right money first analysis. Appropriate asset location analysis. Estate plan evaluation. Lifetime and testamentary gifting strategy, including leveraging lifetime gifts to children and grandchildren, and our tax-savvy Who Gets What estate planning analysis. And all of these will be adapted to your unique situation and calibrated to provide the best results for you and your family. The choice to develop your financial master plan is not a choice to maintain the status quo. It's a proactive choice to improve upon the status quo and secure the future you dream of for yourself and your family. When you meet with Jim, he may propose implementing the superbly flexible Lange's Cascading Beneficiary Plan. Its flexibility protects your spouse, allows for the possibility of directing money to your children after the first death, and allows for the possibility of directing money to your grandchildren with parents as trustees. These options are not available with traditional planning. Lange's Cascading Beneficiary Plan is really an estate planning system that should be considered for virtually all of your assets. It works for wills and revocable trusts, IRAs and retirement plans, Roth IRAs, and Lange's Cascading Beneficiary Plan is only one tool in Jim's arsenal. The first step toward peace of mind and a good night's sleep is to request a Retire Secure consultation with Jim Lange. During your 1-hour private Zoom consultation with Jim and one of his number-crunching CPAs, you'll discover how to cut your taxes and preserve your wealth. Jim will answer all your questions and concerns and likely suggest 2 or more tax-reducing strategies you had not thought about. Jim takes a multidisciplinary approach to securing your retirement. He accounts for taxes, legal, and investments. Jim has given thousands of consultations over the years and has never had anyone say or even imply that it wasn't worth their time. Why? Because Jim delivers real-world value and not a sales pitch. At the end of your Retire Secure consultation, you will have the outline for a concrete plan of action to maximize your retirement prosperity and generational wealth. Then you will have 3 options. You will thank Jim for his time and valuable recommendations and most likely end up doing nothing. You'll want Jim and his team to run full retirement and estate planning projections, producing your personalized financial master plan for a one-time investment of between $12,500 and $22,500, depending on the complexity of your situation. Or you'll want your personal financial master plan, and you'll want Jim's team to help you implement the plan, and have one of Jim's strategic partners manage at least a portion of your assets. If you select option 3, your personal financial master plan is included for free, and your personal financial master plan will be updated every year at no additional cost, provided you place a minimum of $2 million under management. A no-obligation Retire Secure consultation will likely provide you with at least one idea worth 10 or even hundreds of thousands of dollars. You can get it now for free, without obligation. The purpose of the Retire Secure consultation isn't to sell you. It is to determine if you are the right fit to work with Jim and his team. Please note that Jim will not take you on as a client unless he thinks he can save you and your family many times his fee. Jim only has a limited number of slots available for the free Retire Secure consultation before there is a waiting list. Since Jim personally conducts each consultation, and there are hundreds of attendees on this virtual event, Jim will almost certainly not have enough available appointments to meet demand. In addition, Jim's team will likely not have sufficient time to meet demand for financial master plan development. Developing each financial master plan is a time and labor-intensive process, and with ongoing obligations to existing clients, Jim and his CPAs only have so much capacity to take on new clients. So, to secure your free Retire Secure consultation with Jim Lange, click the offer link and complete the appointment request form now. Listen, with the uncertainty in the country, it's natural to be concerned about your financial future. But with proper planning, you can protect yourself and your family from massive taxation, get the most out of what you've got, and maximize retirement prosperity and generational wealth. And the first step is simple and free. Click on the offer link and request your Retire Secure consultation with Jim Lange. Don't wait and be disappointed. A happier, less stressful, and more abundant life awaits. Take action to secure your family's financial future now. Request your free Retire Secure consultation by clicking on the offer link.